Welcome to Catalyst. I'm Madison Mills. 30 minutes into the U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, we break down the market action ahead of Nvidia's results as investors brace for volatility. And throughout the show, we're going to have full coverage on Nvidia's earnings, from the charts to watch to secondary trades that you need to know. You won't want to miss that. Plus, we'll break down the health of the AI rally on Wall Street and if big tech can continue to lead the market after record years of gains. Half an hour into the start of U.S. trading, let's get you a check on the markets. Taking a look at the major averages here, you've got a little bit of a mixed picture, but basically all eyes on that Nvidia print set to report after the bell today. You've got your S&P 500 just above the flat line, your tech-heavy NASDAQ not doing a lot, and the same with the Dow. Of course, investors anxiously awaiting those Nvidia results coming out later today. We are seeing a little bit more activity in the bond market. Taking a look at the 10-year yield in particular, if we're able to pull that up, because it's interesting to see that investors seem primed at the moment to keep the 10-year below 5%, at least for now. We've continued to see that you currently have the 10-year up about 4 basis points, seeing that action to the upside on the longer end of the curve. Yields are up about 4 basis points on the 30-year yield as well. Finally here, let's take a look at Bitcoin. Moving to the downside, it is still, though, above the 108,000 level. Well, big tech is taking the spotlight away from trade tensions and the tax bill, with Nvidia earnings out after the close. So can the sector continue to power the market higher, or will new leaders emerge? I want to bring in my co-host for the hour, Steve Sosnick. He is the chief strategist at Interactive Brokers. And Steve, I always love talking to you because you have such a great sense of sentiment and what's actually going on under the hood in markets. So how are investors acting ahead of this print, and what is that telling you about sentiment?
Well, a few things. Broadly speaking, we saw our customers buying heavily during April. They were astute. They didn't give up faith. Buy the dip has worked for them very well for the past few years, and it did work really well for them again. What we're seeing a little bit now is a little less aggressive buying. They're still probably net buyers, but definitely two-sided. We saw some basically flat side trading in Nvidia and Tesla, some of the big winners. So I think you're starting to see some profit taking among our best, most active customers, I should say. From a Nvidia specific point of view, the way I was looking at the options just before coming on the air, we saw a little bit of modest risk aversion, but nothing too terrible. There's a little bit of a peak probability for a move, maybe of a slight downside. That's not, we're used to seeing Nvidia, everybody expecting the moon from them. We are seeing a bit of skew, basically people bidding up for downside puts in Nvidia, but the at-money implied volatilities are not really particularly worrisome. They're sort of below the recent average of major moves, although Nvidia is basically weird. It'll move 20% or it'll move nothing, so it's hard to say what the right number is for that to some extent. So I would say there's people watching it. I hate to oversell stuff and say this is the most important stock, but it kind of is, because AI has been driving the bus, and Nvidia drives AI. So therefore, it's the stock to watch.
And given its market cap weighting, it's for everyone. It's not just Nvidia-specific investors, but anyone who has a 401k is heavily invested in Nvidia.
That's it. I mean, this is the thing that I don't know that people really fully appreciate. If you're buying sort of the diversified fund, let's say you're buying an S&P 500 index fund, you're heavily invested in the AI trade, because basically, depending on how you want to slice it, a quarter to a third of your investment is in a handful of stocks that are very leveraged to AI, Nvidia being one of them, but also all your other Mag 7 stocks. And so you can't escape this. I mean, this is I'm not saying that's a negative, but you have this exposure to AI in a very heavy way, whether you want to or not.
Well, let's talk about that. Can tech continue to lead the market rally? Can AI continue to really be the determining factor of where this market goes?
It can, if it turns into a profit-making venture. And this is, I don't want to draw too many parallels to the internet era, because we're talking, they're not exactly the same. They're very similar in the sense that you have this world-changing technology that people are all in on, and they're paying big premiums to get. But the difference is then the companies weren't really making any real money. Cisco wasn't making the kind of money that any of these Mag 7 companies are. Amazon, round one, was not a profitable company. It is now. And so the difference here is you've got very profitable companies. So instead of paying insane, obscene multiples for that growth, you're paying full premium for that growth. But I do also wonder, who's the marginal buyer if these things don't, if AI, if all this spending doesn't turn into real money for someone? Basically, if you think of AI as a gold rush, Nvidia is the premier manufacturer of picks and shovels for that gold rush. Think Levi Strauss, 1849 or whatever it was. But this is the company driving it. But ultimately, this has got to turn into bottom line profitability or savings or productivity for people. It probably can, but the question is can you just keep spending on this endlessly until that productivity is reached?
And if not tech, then what? Is it other sectors that may utilize AI to cut back on labor costs, for example? Or what might that other market leadership look like?
In theory, that would be the promise of AI, right? Because then it spreads to, I don't know, in banking, or it spreads to manufacturing. In theory, it spreads everywhere, and that productivity is gained throughout the economy. On the other hand, though, that's much more diffuse. And you've got very, very crowded trades here in big cap tech. Global investors are heavily invested in this. So what we saw in April was what happens if people start to run out of those trades. They get hit really hard because there isn't a lot of unmet demand for this. There's not a lot of money on the sidelines saying, you know what, I'll pull back and get into big cap tech because they're already in. Mm-hmm. And that's why you saw that huge sell-off. That is why it became a buy the dip opportunity, but only after some real selling. I don't know what would have to take the slack. I hate to say 7 and 493, but essentially the other 493 stocks in the S&P 500 would have to. I'm over dramatizing a bit, but that would really have to pick it up. You'd have to see the money flow in broadly into other stocks that are benefiting from these productivity gains.
It sounds like from what you're saying, the other 493 would either have to really pick up the pace, or the slowing growth that we've seen in the 7 would have to somehow have some catalyst to increase that growth rate.
Exactly. They've got it. People are paying a big premium for their growth right now, and if that growth keeps up, by all means, they're going to keep going. If not, there's always fresh money going in, because again, the weight of money, if just money flows into the S&P 500, by definition, it's flowing into these stocks because just of their girth. But you want a fresh catalyst. Ultimately, if you've got a company like Google that's spending $75 billion on AI, now some of that is to protect their very valuable search engine turf, but how much of that is playing defense, and how much of that will be they have to play defense because they can't cede that ground, let's say to Bing or something like that, where Microsoft, could take their relatively small market share and grow that. If they grow that into something bigger, that's great. But ultimately, somehow this has got to turn into, real world savings or profitability or productivity for somebody.
Right, got to see the ROI. Steve, thank you so much. Really appreciate it. You're going to be with us for the hour, and we'll have more insights from you. But coming up, we're going to take a look at some trending tickers on the Yahoo Finance platform. We'll bring you the news behind those moves next on Catalyst. Stick around.
Big event on deck. Nvidia reports first quarter earnings, and the options market is already buzzing. But what should investors expect from the stock after the report drops? I'm Jared Blickery, host of Stocks in Translation. First, the big picture. Historically, Nvidia's stock reaction is a mixed bag, but leaning bullish immediately after earnings, with median gains of just 2 to 4% over the first month. But then watch out, the stock tends to blast off, about 18% historical gains by the end of the quarter, and a whopping 117% return 1 year later. And the longer you hold, the better your odds. A positive outcome happens about 83% of the time after 1 year. Now let's zero in on the AI area. This is the past 10 reports, so artificial intelligence has been the name of the game, stretching back 2.5 years. The stock's next day pop has averaged nearly 12%, but the options market is only pricing in a 7.4% move after the report. That means traders might be underestimating the impact of Nvidia's earnings. But outside of earnings, Nvidia's typical daily move is only about 4.5%. This means earnings days are 2 to 3 times as volatile volatile, and here's the scorecard. 6 big wins with an average gain of 11% over the last 10 reports against 4 losses with average dips of about 5%. Basically a coin flip, but the wins have paid much bigger than the losses. And if you're a long-term holder, here's your rolling gauge. Nvidia's one-year returns measured from each earnings date are currently at all-time highs. Multiple years have posted gains over 100%, with only brief dips below zero since 2010. Momentum clearly favors patient holders, but this number has dipped below zero before, so there are no guarantees. And the bottom line for traders, expect wild short-term swings, but over the long run, Nvidia's trajectory has tended to be up. And here's a pro tip. Given history, options might actually be cheap here, so volatility buyers take notice. Well, Nvidia's report, will it extend this incredible streak or will it break the trend? Stay tuned. And tune in to Stocks in Translation for more jargon-busting deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
It's now time for some of today's trending tickers. We are watching Honeywell, a deal between Toyota and Joby, plus mortgage giants Fannie Mae and Freddie Mac. First up, Honeywell adding an executive from activist investor Elliott Management to its board. That's according to the Wall Street Journal. This does come as the company's been preparing to split into 3 separate entities, separating its aerospace division, automation business, and advanced materials arm. Elliott originally did call for that breakup after revealing a $5 billion stake in Honeywell last year. Steve Sosnick still here with us for some insights. And it's interesting, Steve, looking at the market action here, when you look at peers in this space that are a little bit more specific, the way that Honeywell aims to be after this breakup, they do trade at higher multiples than Honeywell. So I wonder how much upside there is in this breakup.
It worked for GE, basically, a very similar type of divestiture program. And I guess, that's probably, I certainly can't get into Paul Singer's head, but I think that's got to be largely what's driving him is the success of GE, which had fallen to become a real laggard, which Honeywell isn't a total laggard. Sure. But when you think of the sum of the parts of GE, after they started to divest into pieces, it's worked. And so Honeywell's probably, we're looking at the same type of sentiment, the same type of model, and we'll see if the market embraces it the same way.
Right, taking page out of that book and out of the activist investor playbook as well here. But let's take a look over at Toyota. Now, the top shareholder in air taxi company Joby Aviation following a $250 million investment. This payment bringing Toyota's stake to over 15%, surpassing Joby's CEO. This is part of a previously announced $500 million commitment from Toyota. Joby saying recently it's aiming to start commercial services in Dubai by early 2026. That is later than the previous target of the end of this year. I was able to speak with Joby's CEO out in one of their headquarters in California. And Steve, what's interesting is that their assembly line, they say, models Toyotas, and that it's very, very much so meant to, mirror the way that a car is put together, with these eVTOLs being put together in the same way. But the question is when these eVTOLs will be able to take flight. I think that's the key question for the revenue perspective.
Well, the stock chart today has definitely got that vertical lift off.
True.
I at some level, I always sort of wonder, how much is buy the rumor, how much is sell the news. I mean, if it's 250 million out of 500 million that you knew was coming, you might argue this is a little much. But in general, I think if you can, pardon the pun, get these things off the ground, this is, it's good news. These are highly speculative stocks, and I'll believe it when I see like my investment banker friends taking Joby's out to the Hamptons. But in the Dubai certainly seems like a good place to start because you have the right sort of audience for that.
Different regulatory framework as
Absolutely.
well. With the FAA has a lot on their hands
Absolutely.
at the moment, so it'll be interesting to see what that certification process is going to look like. But finally here, let's move over to Fannie and Freddie here. President Donald Trump vowing that the government will maintain guarantees and an oversight role over Fannie Mae and Freddie Mac as the president moves to take the mortgage giants public. Trump writing in a post on Truth Social that he's working on taking the companies public, but, quote, the U.S. government will keep its implicit guarantee. Steve Sosnick still here with us for Insights. Steve, what do you make of Fannie and Freddie going public here?
Well, I mean, it's, returned to what it was before. These were, the problem before the global financial crisis was, to a certain extent, we were privatizing gains and socializing risk. You have to wonder if we're sort of going back to that model and setting up for that type of situation down the road. This has been a good bet for people who've who believed in this story. When you think about it, just about a year ago, the stock was trading between $1 and $2, so it was essentially like buying a warrant, a very long-term option. You'd say, all right, what am I going to lose, $1 or $2? And what can I gain? A lot, and they're gaining a lot because the stock, last I looked, was about $11 or something like that. So it's worked. I think we're still a little light on details here, and we'll see how that all works out. And I'm sure Congress has to get involved in something of this nature as well. But in the short term, there's a lot of sizzle to the story, and I understand why people are embracing it.
But I'm curious too how much risk there is for those investors who might get in on these names before a potential.
Well, because you don't know what the details are.
Right.
So we don't know. So yes, privatize it. What does that mean? Does the government issue a whole, do you get diluted by stock, by the government issuing tons of stock against you? Investing off of, making a long-term investment, a corporate investment off of a Truth Social post or any social media, I don't mean to pick on that one. These, they're somewhat light on details, and so I wouldn't necessarily go too crazy on this. But yeah, it's, as a theme, it worked so far. I mean, it's this has been what people have been looking for, some sort of move in this direction, and they definitely got something that plays in their favor today.
Yeah, absolutely, and you can see those tickers moving to the upside here. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, we're going to zero in on AI, from the infrastructure behind the technology to the geopolitical tensions around it. That's coming up next on Catalysts. Nvidia earnings due out after the closing bell today. I want to bring in our very own Josh Schaefer. Steve Sosnick still here with us, but Josh, I know that you're looking at a few charts that investors should keep top of mind heading into the print today.
Yeah, Maddie, so we took a look at a list of charts since the launch of ChatGPT, which would have been November of 2022, and just tried to explain Nvidia's performance. How did we get here 2 years later after really what was that big earnings report 2 years ago that sent the stock soaring, right, in May of 2023? First chart is pretty simple. It's just the top 5 performers in the S&P 500 since ChatGPT was launched. You can see Nvidia far outperforming the others there. Interesting point on this chart as well when you take a closer look at it. Several of the stocks that are included in the best performers in the S&P 500 actually weren't even in the index when ChatGPT was launched. I'm looking at Supermicro Computers, Coinbase, to name 2 of those. And then I think other interesting here is just how Nvidia has sort of surpassed its competitors, right? So we took a look at simply market cap growth among 3 companies that really should sort of be in this AI race. You, of course, have Nvidia, you have AMD, and you have Intel, which market cap has actually fallen over the last 2.5 years. But I think the core question here, of course, is why, right? And you hear a lot about sort of the hype story with Nvidia. You can go to a bar in Manhattan now and someone might talk to you about this stock and they don't really know exactly what it does, right? But when you look at the fundamentals and you look at simply the revenue growth that this company has seen since November 2022, it's absolutely skyrocketed, right? Yeah. You were in revenue less than 10 billion. We're zooming in on that chart right now. Revenue closer to almost 40 billion from a total. That purple section there is data center revenue. Of course, that's the key metric. Steve, I look at a chart like this and it makes a lot of sense to me why a stock would rally as much as it has, right? You're looking at a massive rate of change in the fundamentals of the company. But I also look at that chart and I see it not growing as much every single quarter, right? And it makes me sort of wonder, if I'm an investor, what happens next after this sort of rally, and how do we think about the fundamental story of Nvidia?
The law of large numbers catches up to you sometimes. I mean, when you think about it, before you came on, Maddie and I had said in a prior segment that I contrasted the current AI gold rush with, let's say, with the internet era, which and I said these companies make money. I mean, Nvidia is trading at about a 31 estimated PE, but its PEG ratio, meaning the price earnings, the forward price earnings over its growth, is about 1. That's typically not a worry. You start to worry when you see 2, 3, 4, 5, or infinite. But in this case, the earnings, you're getting delivered earnings. You're getting delivered top line and bottom line. So ultimately, yes, it's hard to imagine that this growth rate can continue just as the company gets so big. It's now the second largest component of the S&P 500.
Yeah.
But to your point, it's there. Top and bottom line is there.
Yeah.
It does make some sense.
Well, another question I have too, if we can pull up the second chart here that shows Nvidia outperforming some potential competitors, the likes of ARM and Intel. Steve, is that bullish or bearish? Like, is that outperformance going to be justified going forward, or is that a valuation fear chart to you?
The question is, can the other ones, is their lead insurmountable?
Right.
And tech is littered with companies who had insurmountable leads that got caught upon. I mean, you mentioned Intel, among others.
Sure.
So is it going to happen next week, next month? Probably not. Will some of these other competitors catch up? Or the flip side is, does the DeepSeek situation mean that people can get away with
DeepSeek? Like, we're not talking about DeepSeek enough, I think.
Exactly.
I mean, you correct me.
No, it's the first time I've used the term in weeks. But was that a flash in the pan, or was that real? If it, and I think we'll probably hear something from Jensen Huang, tonight about that.
Yeah.
But if there are alternatives to some of the more expensive, Nvidia chips, which, to be fair, again, using my limited knowledge of chipset design, Blackwell seems to be the real thing in terms of the amount of calculations it could do, price-performance ratio. But do you need that do you need that to get to where you need to be in AI? That's a huge question as well.
Well, and to the DeepSeek point too, I think the other question here is, so if I'm an investor and I just want to invest in the broad AI theme, do I then move from maybe semiconductors into something else, right? I was just at an Outlook earlier this morning with the team over at Bernstein Private Wealth, and one of their strategists was saying, well, we're telling investors, if they come to us and just say, we're interested in AI as the theme, maybe look at a big box retailer that could benefit from AI, right? If we're thinking DeepSeek could disrupt the chip organization and DeepSeek makes everything cheaper, well, where does that sort of fall and who does that benefit? It would benefit the end user, right? And so where are the opportunities sort of outside this space? Steve's smiling like he probably already made this point earlier, right? But I think that's definitely one of the growing conversations that we've continued to talk about more and more, it seems like.
Maddie elicited that comment from me earlier. So yeah, this is exactly what it is. Ultimately, for the same reason the internet worked and became a transformative technology, it was because companies could do stuff with it that really helped their bottom line. The company I work for, Interactive Brokers, we had this tiny little web brokerage division, and now as a result, now the business model of our company is completely different than where we were when I joined it, in a good way, right? But so this is there are going to be uses for AI. There's if the promise is real, it's going to affect all kinds of companies.
Yeah.
But it's not going to happen overnight, and we have to see that at some point, because you can't just keep spending money, billions of dollars on stuff without it actually yielding some result.
Well said, Steve. Thank you so much, and thank you, Josh, for bringing us those fantastic charts here. Well, high-performance computing plays a critical role in the world of artificial intelligence, providing the computational power needed to train, deploy, and scale intelligent systems quick and efficiently. NVIDIA's results bring into focus the power demands needed to support AI. Joining us to discuss, we've got Ben Gannon. He is Bitfarms' CEO. Bitfarms is a Bitcoin mining company that is expanding existing data center infrastructure to support HPC and AI workloads to meet the growing energy demands of the industry. Ben, it's always great to speak with you. We were just talking on set about how we kind of need to see the proof in the pudding when it comes to AI ROI, and you are a great person to talk to about this. How and where are you seeing the investment in AI playing out in terms of high-performance computing and infrastructure going forward?
Yeah, it's a great question. For a company like us, who's really been focused on building data centers for the last few years that were powering Bitcoin, I think the important thing to focus on is what does these new business streams mean for your multiple and your valuation? And as a Bitcoin miner, most companies in our space usually trade around a 3 to 5 times multiple, but data center companies trade around a 20 to a 30 times multiple. So because of those contracted revenues, because of that certainty over the long period of time, you're able to unlock a lot of value for shareholders. And so I think for the investors who are looking around at HPC and AI and trying to figure out where are the opportunities after NVIDIA has had such a huge run up over the last 10 plus years, where else are you going to get those opportunities? And the reality is that as NVIDIA continues to sell more GPUs and as these GPUs consume more and more power, it's really the infrastructure which is going to be the bottleneck and the really key element here that's going to enable all these companies to benefit from AI.
And to the question of which companies benefit from AI, one thing we've been circling this morning is the idea of digital assets benefiting and cryptocurrency players benefiting as well. How are you seeing that relationship developing going forward?
Oh, it's completely changed the industry almost overnight. 12 months ago, there was very few companies that were looking away from pivoting from Bitcoin mining and crypto into HPC and AI. But the math is really, really compelling. And when you look around at the data center companies that exist today, there's kind of two buckets. You have the traditional data center companies who have really been focused on building large portfolios of small sites. And then you've got the Bitcoin miners who were focused on building small portfolios of large sites. And when you look at what the data center needs are for not only for today, but for the future, the reality is there's no data center that's built today that's going to power the GPUs of tomorrow. And so the scale that Bitcoin miners have gives a very, very fast pathway and a very more cost-effective approach towards building that new infrastructure a lot faster.
And Ben, my co-host for the hour, Steve Saznick, has a question for you as well.
Hi, Ben. The thing that strikes me here is Nvidia, call it 3-4 years ago, was really the all-in company during the first sort of Bitcoin run and the first crypto run. And it's almost like the industry's following Nvidia just a little bit late. Am I wrong in thinking that's that analogy is correct or incorrect? That it's sort of Nvidia sets the path and the people who use their chips extensively follow along?
Well, Nvidia is really setting the pace here in terms of the technological development of these chips. But computing is something that's growing at an exponential rate for the last 80 years since it was invented, with Alan Turing and the Enigma machine in World War II. With Bitcoin mining, we've had the very, very fast growth rate over the last 16 years. And so there's a lot of things that are taking place right now where the math is just really, really changing at such a fast pace that you need to be agile. You need to be able to adapt. You need to be able to change your approach to the changing market demands because HPC and AI before ChatGPT was really, for most people, a theoretical thing. But when ChatGPT came out and you had a consumer-facing application, it became very real and very tangible for people. And that seemed to spark a gold rush. But I think from where I'm standing and from the customers' conversations that we're having, the demand is just infinite. And we really have barely even begun to scratch the surface of what's possible here with these new chips and this new kind of computing.
And I hear you that you're seeing that demand be infinite, but one of the key questions for investors is whether that demand is going to be infinite for Nvidia. If we do see soft earnings results from Nvidia this evening, how does that impact your business and your confidence in that demand picture for AI?
Well, the bottleneck on growth for compute has always been power outside of the silicon shortage of 2021. So chips are available. They're always going to be available. And Nvidia develops at such a fast pace that there's a new generation of chips roughly every 12 months. But at the back end, you always need to have the power to plug in those chips and operate them so that you can actually generate value out of them and you can generate that return on your investment in the GPUs. So from our side, we haven't seen any reduction in demand. Even when the DeepSeek news came out a couple of months ago, there was no reduction in demand. There was no slowing down of these infrastructure buildouts because they're something that may be taking 2 to 5 years to build out one of these large data center campuses. And you really can't get distracted by a headline that's going to put you back.
Ben, really appreciate you joining us and giving us that context. Thank you so much.
Thank you for having me.
Nvidia's earnings results bringing into focus the geopolitical tensions surrounding artificial intelligence as the world's two largest economies look to win the race for AI dominance, with the U.S. restricting sales of powerful AI chips to China. Joining us now, we've got Nina Schick, author and advisor specializing in AI, geopolitics, and power. Nina, it's great to have you here with us. I know you say controlling AI is not just about the technology, it's about writing the rules for the next century of global power. How does that inform your thinking on who the winners and losers to come out of this moment may be?
Well, I think the first thing to say is that this is the most important geopolitical story of our time, of the 21st century, because traditionally technology has always been an accelerator of global power. But when we're talking about actually artificial intelligence, when we're talking about actually being able to create intelligence that is cheap and available like a commodity, well, that's fundamentally different from any technology we've had in the past. That's why you see this talk of the AI war. And to be completely honest with you, even though all countries are starting to understand that there's this new kind of geopolitical order being shaped by technology dominance, the two players in the race, and of course it sounds a bit hackneyed and cliched, but undoubtedly it is the United States and China, and that is going to be the story of the 21st century. It is the competition for technology dominance between these two superpowers.
So talk to me, Nina, and thank you for that overview. If you talk to CEO Jensen Huang, he would say that the current work of the U.S. and the Trump administration to curb China's excellence on AI is not the right approach. He sees the current chip curbs as something that could potentially benefit the likes of Huawei going forward. What is the right approach then? If the Trump administration were to call you and ask for your input on the right approach to winning on AI, what would you say?
Absolutely. So the first thing to say about the Trump administration is just how interesting it is since Trump 2.0 came into office, how much they've kind of identified AI and technology dominance as a priority for the administration. And of course, the export controls started in 2018. But we've seen how, if you look at where each superpower, each has its Achilles heel. And I would say that for the United States, the Achilles heel is the lack of the industrial base which China has. We've already heard from your former guest how the infrastructure, the energy requirements, the kind of rare earth materials are absolutely essential to kind of scaling artificial intelligence. So if that is the US's Achilles heel, the Achilles heel for China is compute. But of course, ever since these export controls have come into place in 2018, it's kind of leading to this incubation of innovation in China. That was kind of the DeepSeek moment, just because of how efficient DeepSeek, this AI lab, which apparently came out of nowhere, was at running inference, 96% more efficient than the kind of US labs were doing. So there is an argument that by enforcing these export controls, you are just incubating this extreme innovation. Just today, we've had news from Huawei, and of course, there's also Baidu, that eventually, and by the way, that is the stated ambition of the Chinese government, that they will have semiconductor sovereignty. So this will continue to play out, but I think the fundamental thing is that each of the superpowers has its Achilles heel. For China, it's still compute, and for the US, it's this industrial base, starting with energy production.
And Nina, my guest host Steve has a question as well.
Hi, Nina. My question is, if it's this duopoly between the US and China, where does this leave Europe and the rest of Asia, or even Africa for that matter?
It's a great question. I think this is a new world order where the competition is between the two superpowers. And each of the other regions is going to become a swing state or be aligned with one of the superpowers. That's why it was so interesting to see what President Trump did just the other week on his great tour of the Gulf, where he signed these mega deals with the UAE, with Saudi, with Qatar, almost to the value of $3 trillion. All of those deals have to do with AI infrastructure, with selling AI services, including Nvidia services, by the way, to the Gulf. So you see kind of this great realigning of the Gulf with the United States. And you would think that Europe actually should be a third contender in this race, but actually they have a systemic disadvantage, which neither the US nor China has, and that's that it's a bloc, right, of 27 countries. It's very hard to have a cohesive industrial policy, very hard to have a cohesive energy policy. And even though they have the talent and lots of capital, they cannot deploy as fast or on the scale that you're seeing between the US and China. So right now, I'd say you see the US and China leading. Europe a little bit astray, also because it is an ally to the United States under the Trump administration. And really interesting moves where you see the entire Gulf now, thanks to the value of these tremendous deals being signed with the Trump administration, kind of lining up with the United States. And of course, that will have caused consternation in Beijing, because Beijing has been doing this and for a long time, under the kind of the Belt and Road Initiative, where they've had the foresight to understand that infrastructure is going to be a form of both hard and soft power going forward.
Nina, really appreciate your time this morning. Thank you so much for that context.
Thank you.
Coming up, we're taking a look at how persistently high rates are impacting real estate. Stick around for that conversation next. Treasury yields are slightly higher this morning as investors await the FOMC meeting minutes and any insights into the Fed's rate path. Meantime, Japanese bonds coming off their weakest auction in nearly a year, sparking concerns investors have little appetite for long-duration bonds on a global scale. So is that sentiment echoed among ETF investors? I want to bring in Matt Collins. He is PGIM's head of ETFs for this week's ETF report, brought to you by Invesco QQQ. Great to see you this morning here. Talk to me, Matt, about the correlation that you're seeing in terms of bond market action and the sell-off that we've seen in treasuries, coinciding at times with a little bit of a sell-off in stocks as well. What is that signaling to you about investor sentiment?
Thanks for having me. So I would say, generally speaking, if you start in January, bonds have gone through multiple regimes in just a few months. And put frankly, bonds have not found their footing. And if you use ETF flows to really sort of diagnose where the interest is and where money is going, you're just not seeing a ton of money move to longer duration bonds. Most of the allocations in the market are going to ultra short ETFs and AAA CLO ETFs that have very limited duration but high quality. And I think that's a great signal that investors are just not quite there yet, that there's a firm foothold in where rates are going.
And is that a signal to you that investors are prioritizing income generation amid the market volatility?
Yes, absolutely. So I think one of the cautionary tales, whether it's in the equity market or the fixed income market, is income is great, but if the capital risk overwhelms that income, you have a problem, right? It's not what you expect. And so with short-term rates paying a pretty healthy margin over risk-free, you're seeing people say, that's good enough. I like 4 or 5% in that allocation. I'll stick there and not have my capital risk sort of overwhelm the income I'm getting there.
And my guest host, Steve Sosnick, has a question for you, Matt.
So, Matt, the question then would be, it implies that we would need a steeper yield curve to get people to invest in longer duration paper. That means yields go up, bond prices go down at the long end. How steep do you see the curve needing to be to re-incentivize people?
I think it's more about a volatility. I think the volatility, go back 5 years. The bond market has returned negative, the broad bond market has returned negative 5%. The equity market has returned 100%. So the income is there, right? Everyone's watching yields, but the equity market is so outpacing the bond market. I think it's more about volatility reduction in the bond market and finding that foothold before you see people come back.
So therefore, then the index to watch would be the MOVE index or something like that to keep an eye on bond market volatility, if that's the case. And then if that's the case, how do you see that spilling in? Do you see that the bond market volatility either ebbing or equity market volatility picking up to sort of match the volatility that we're seeing at the long end of the curve, considering that stocks are the ultimate long duration asset?
So we're on one of the most epic runs in the equity market that we've seen in a really, really long time. And the expectation, I think, is that moderates and becomes a little bit more sideways. And if you look at flows, one of the most dominant flow gatherers on the equity side is defined outcome ETFs, where you can put sort of a window frame around your S&P 500 experience. On a 12% buffer, as an example, you have no losses if the market is 12% or less down, and then you have upside up to, say, 16% or so. What we expect is a more sideways, more volatile equity market, and then money starts coming off that side of the table into defined outcome ETFs on the equity side, and then potentially, again, you find your footing in longer duration bonds on the fixed income side.
Matt, really appreciate it. Thank you so much.
Thank you.
The Federal Reserve is not expected to cut interest rates until September, but what is that going to mean for rate-sensitive industries like real estate? Our next guest says private capital and private credit are filling the gap left as banks continue to remain on the sidelines. Joining us now in studio, Richard Litton. He is Harvard Group International's president with $19 billion in assets under management. Richard, it's great to speak with you. Talk to me here about where you are seeing private capital coming in and bridging lending gaps in this environment.
Yeah, it's a very important topic in the real estate industry, and as you alluded to, commercial banks have retrenched on real estate. So private lenders are very supportive of the industry, and there's a lot of capital around private real estate credit. I would say it's focused, as you might expect, on product types with very strong fundamentals, like multifamily, for example, could be very different for office. Multifamily also benefits, obviously, from Freddie Mac and Fannie Mae, who provide very important debt liquidity to the apartment sector.
Since you bring it up, I have to ask, Fannie Mae and Freddie Mac going public.
Right.
What is your take?
Well, it's been discussed before. It's not a new topic. It tends to be discussed more frequently in Republican administrations over time. I think the important thing is what the president said yesterday, separate and apart from whether it goes public, how it goes public, is the government guarantee, the implicit government guarantee behind those financing sources for the housing market, particularly important in the single family market, which is the vast majority of Freddie Mac and Fannie Mae's business. You pull back the implicit government guarantee, it's only going to elevate rates. So I think they'll be very cognizant of that, particularly given how high interest rates already are for home buyers.
Well, and that brings me back to the private lending conversation.
Right.
And part of that is a lack of transparency that is baked into how private lending works. Is that something that consumers should be concerned about?
Well, in our business, at Harbor Group, we're lending to sophisticated counterparties that are also sophisticated investors. So I would say that is a transparent process, certainly to the extent, private debt firms like ours are, accumulating loans, going to the securitization market. There are a lot of bond buyers looking at a lot of data, and making their own risk assessment. So I think, in the commercial real estate sector within private debt, we certainly feel good about overall market transparency.
One question I get all the time is every new asset class, every new financial innovation gets its real world test.
Yeah.
Some pass, some don't.
Right.
Has private credit had its real world test yet? And if so, if not, I should say, how do you think it fares, and where do you think the risks are within that sector?
Yeah, I mean, we are still in a period where there have been a lot of tests. If you look, many private lenders in commercial real estate loan on a floating rate. And so loans made in 2020, 21, early 22, when SOFR was 25, 30 basis points. So now SOFR, in the fours, it got in the fives, debt matured, interest rate hedges, caps burned off. It's put a lot of pressure on borrowers and lenders. It's meant that lenders have had to at times take back assets, or if they feel good about the borrower's ability to recapitalize, they'll work with them. So we're very much in a testing period now in this elevated rate environment, and I think in our industry, asset management experience in real estate has been so important to work through some of the issues private lenders have.
And we came into your segment also talking a little bit about the moves that we're seeing in the bond market, and Steve asked a great question about how much yield investors are going to require to own on the longer end of the yield curve. How are you thinking about the bond market's impact on your business? Yeah,
well, in our credit business, the elevated index treasuries for fixed rate credit investments, SOFR for floating rate, that's, you start out the gate with a nice spread or a nice return, and then it's what spread can you put on top of that. So we see very good income generation opportunities in private real estate credit. The last guest talked about the importance of income, though, and also risk. So where are you in the capital stack? How low are your LTVs? What are the underlying fundamentals of the properties? That helps you formulate your risk assessment as you think about returns. And I think there's we're back, a number of partners and myself just back from meetings last week in Japan and South Korea. A lot of institutional investor support for U.S. private credit, particularly in multifamily, because the fundamentals are so strong at the property level.
Interesting time to be in Japan amid those bond market auctions too.
Yeah,
Richard, thank you so much for joining us in studio this morning.
It's a pleasure.
Really
Thank you for having me.
Thank you so much. Coming up, we're going to break down the implications of the tax bill for investors. Stick around for that next on Catalysts. Elon Musk criticizing the Republican tax bill, telling CBS he was disappointed by the giant tax bill, saying it undercut his efforts to slash government spending. I want to get final thoughts from my co-host for the hour, Steve Sosnick. He is Interactive Brokers chief strategist. Steve, I keep hearing mixed messaging on what this tax bill is going to mean for investors. There's a camp of people who tell me this is the policy dessert investors are waiting for, and once this happens, we're going to be in markets euphoria for the second half of the year. What tariffs? And then others tell me that there's a little bit of a contradiction in tariffs and the tax bill. Do we keep tariffs around as revenue raiser to pay for the tax bill? Which camp would you put yourself in?
I would say watch the bond market and they'll give you the final vote. I think right now is there's been certainly in the new bill you have. Well, there's two ways to balance a budget, right? You cut spending and you raise revenue.
Yeah.
There's really the only way that they're trying to raise revenue here is via tariffs, and that's not a particularly market-friendly way to do it. And even so, the tariff. Good for the market that the tariffs seem to be coming off the highest levels, but that doesn't really help the budget deficit portion of it. And regarding Elon Musk's criticism, this is what you get when you go into government. There's a lot of cooks making the soup there. You run a private company, you've run several private companies, but he's always been the final arbiter. In this case, there's always a lot of hands in the pie here. And I think that's why my key focus has been on the longer end of the curve, which I alluded to earlier, because if the bond market is nervous that they're not going to get paid, that there's going to be trouble raising the amount of debt that's required to service the new budget proposals, that's going to be problematic because it spills back a little bit everywhere, and we're seeing it globally. It's not at nervous levels yet. 4.5 on the 10-year is something we can live with. 5 on the 30 is something we can live with. But that's my focus.
Yeah, and that is certainly something for investors to watch. Thank you so much, Steve, for joining us for the hour. Always great to have you. Coming up, we've got Wealth dedicated to your personal finance needs. Brad Smith has you for the hour.